In this part, I'm introducing the gross profit methods to estimate inventory. In some circumstances, it is impossible to get the actual value of inventory. So estimating inventory is more applicable and economical. So how to estimate inventory? We're going to use the very important equation. So the beginning inventory plus purchase equals the cost of goods sold and ending balance of inventory. Both beginning balance of inventory and purchase are available. If we know cost of goods sold, we actually can have the ending balance of inventory based on this equation. And we know cost of goods sold is revenue subtract gross profit. In the income statement, revenue subtract cost of goods sold is gross profit. We transform that equation into this one. Yeah, basically, if we have the revenue and we have the gross profit, we can get cost of goods sold. Based on this equation, we can get the ending balance of inventory. The reason we can use this method is because for some firms, the relation between the revenue and the gross profit is stable when the firm has stable mix of products and cost structures. Or we can say the gross profit divided by revenue. We know this is a gross margin, right? It is stable across different years. Because this relation between gross profit and revenue is stable, so we can use this relation to estimate cost of goods sold. Because we're using gross profit, right? So this is called gross profit method. This is an example. This exhibit is based on the equation I just showed you. Beginning inventory plus purchase. The total is cost of goods sold available. That's at the cost. Then we can use the sales revenue subtract gross profit. So we can get the sales at cost or cost of goods sold. Then the difference between goods available and the cost of goods sold is ending balance of inventory. So the key here is gross profit margin. Actually, the computation of gross profit percentage depends on the definition. The gross profit can be calculated in two different methods. One is markup divided by the retail. The other is markup divided by cost. This example tells us the cost is 15, price is 20. The markup or the gross profit is $5. If we calculate gross profit percentage using this method, it is gross profit divided by the price, 25 at retail. We can also use markup or the gross profit divided by the cost rather than the retail price. We can get another percentage. This is gross profit on cost. 25%, 33 and a third percent. They are different, but they describe the same fact. Okay, they're equivalent. Based on the given information, sometimes you're given the gross profit on the selling price or percentage markup on costs. We can convert these two gross profit mutually. So if we have a percentage markup on cost available, we put into this formula, we can get the gross profit on selling price. If we have the gross profit on selling price available, we can put into this formula to get the percentage markup on costs. So these are examples. 20% gross profit on selling price is same as 25% markup on costs. Or 25 gross profit on selling price is equivalent to the 33.3% as the percentage markup on costs. Next, we're going to use an example to show you how to estimate the ending balance of inventory. What we are given is the beginning balance of inventory at the cost, purchase at the cost. The gross means if we subtract the purchase discount, we can get net purchase. And the freight in are part of the purchase, but we reported them separately. So that's actually the left side of the equation. Beginning balance of inventory plus purchase. It equals to what? We actually use sales multiply 1 minus gross profit divided by sales. This part I circled is estimate cost of goods sold. Then plus ending balance of inventory. Yeah, we have sales return, so that's a net sales. Gross profit, yeah, we're given the percentage. So we can calculate ending inventory. So next slide shows the calculation. We put all the information into this table. The beginning balance, the inventory at cost, purchase, gross, and we subtract purchase discount, so this is net purchase, and we plus freight in, which is part of the shipment cost. We also consider the shipment cost as part of the inventory. So the first 4 items is goods available. So that's the total of them, 818,000. The next is we are going to estimate cost of goods sold. We know cost of goods sold is the difference between sales revenue and gross profit. Before we do that, we first calculate net sales. Net sales equals the sales subtract sales return. So the net sales is 930. Then we estimate gross profit. Gross profit basically is sales multiplies the gross margin, which is the percentage given. Okay, it's gross profit divided by sales. In this example, we're given 25 is gross profit, 20% of the sales. So we can use it directly by multiplies the net sales, 930. Then 232,500 is gross profit. Then we subtract the gross profit from the net sales. This is estimate cost of goods sold. The difference between goods available and the cost of sales is ending balance of inventory. Yeah, remember we are using a single percentage applied to all the sales, right? So this is just an assumption. The reason is we assume the gross profit margin is stable for this company through different years. If we investigate each specific inventory, their gross margin may be different. But as a package or as a mixed, the gross profit is stable. In practice, it saves a lot of time without losing any accuracies. The next one is we're given the gross profit of the cost. Keep in mind, this is of cost, not of sales. So we cannot use it directly. We first convert the percentage of cost into percentage of sales. Please refer to the prior slide for this conversion. Then we can get 20% of sales as the gross margin we can use directly. Okay, first we get all the goods available for sale, 818,000. Net sale, 930. The 20% of sales revenue multiplies net sales. So the gross profit is 186,000. So cost of goods sold estimate is 744,000. So the estimate ending balance of inventory is 74. Although gross profit methods save accountants a lot of time and can provide accurate and timely information, but it has several disadvantages. First, it is an estimate. The percentage may change. The percentage of sales or percentage of costs we use are based on historical information, and we assume this percentage can be sustainable in the future. So if the firm has the product mix change or cost structure change, we should make adjustment to the percentage. And also, we should be careful when applying a blanket gross profit rate when they are varying gross profit. And also, this is not for financial purpose. It is just for internal use. In financial accounting, we do not use for reporting purpose. So the US GAAP or the accounting standards still require a physical verification of the inventory.